All right, good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of 3 simple steps to time your entries and exits. Our presenter today is Sandy Chaikin, co-founder of Chaikin Analytics. Now be sure to submit your questions throughout the webinar using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. I'll be available throughout the presentation to respond to your questions. As a reminder, this webinar is being recorded and a copy will be sent to everyone who is registered. Be sure to follow along our presentation by following Sandy's investor workbook. A link to this workbook will be made available in the chat window. Now, with no prior experience, Sandy started investing in 2012 with Chaikin Analytics and built a killer portfolio that outperforms the S&P 500 and most money managers. Sandy presents at NASDAQ and industry conferences on fearless investing. To get us started, here's Sandy Chaikin.
Joe, thank you so much, and thank you all for attending today's presentation. So today is all about 3 steps to time your entries and exits. We continually hear this, as does Joe and his customer success team as well, as this is the biggest challenge facing investors today of how do you know when to get in and how do you know when to get out. So the purpose of today's presentation is to address that and leave you with answers and a clear-cut path you can follow. So what I always like to do is look at the overall market, because whatever we do has to fall within the context of what's going on in the overall market, which we use as the S&P 500, which is what most investors use as well to gauge themselves against. So as you can see, we've had quite a bit of turmoil, volatility lately, starting early February, a 10% correction, then it went up into this little W pattern here, and now it's pulling back again to this possibly W pattern as we speak. This is apparently quite normal for the stock market. This is not something we should panic about and bring back fears of 2008. But as you can see here, these are the dips since the market corrected after the financial collapse of 2008. So going back to March of 2009, what is that, like 9 years ago, I guess? You can see there's a number of pullbacks, 5, 6, 7%. Some get into correction territory, which is over 10% down here. More recently, that one in February took us back 10%. So we're no longer in a buy on the dips mode, but this is a term to correction. And it looks like we're hitting that again here, which is this possible W bottom here. I point this out because it's important to put this in context too. And this will help guide your investing decisions as well. Because what happens is there tends to be a lot of fear when the volatility comes back to life, and we were kind of lulled into complacency with that in 2017. But it's come back with a vengeance, and that apparently is normal. So if you look at the average declines in the 5 to 10% range, which is that pullback range, they tend to pull back an average of 6%, and they take 1 month to kind of get back into the right frame of mind. The corrections in the 10 to 20% average of 13%, and we actually hit 13% down intraday yesterday from the high, and they take a little bit longer. So we're probably in this 2 to 4 month time frame before we'll see the end of this volatility. So I think it's safe to say expect a lot of volatility in the next 2 to 4 months. But this too shall pass. And with the earnings-driven market that we've been in, there really are no signals or signs of any type of recession. So the problem I always like to address head on is that the S&P has grown an average of 10% over the past 20 years, even with all that volatility built in. However, individual investors have only averaged 2.5%. And that's because we're people. We have emotions, and we let our emotions get in the way, right? And we base decisions, sadly, on emotion, not always on fact. But this is expensive, and this will cost you an average of 4% a year, taken right off the top of your performance. That's a big number, and particularly if you compound it year after year. So it's really important to find a disciplined methodology that you can trust and that you will follow. And when you follow it rigorously, you will save yourself that 4% a year, and you will get up into the higher, at least 10% a year S&P averages. And by investing in individual stocks, as we're going to be outlining herein, you should be able to do a lot better than that industry average. So I always go back to what Warren Buffett says: investors should be fearful when others are greedy, meaning when others are buying, they're greedy. They all jump in because the bull market's on a tear. That's the time to be fearful, i.e. sell, because that's when the stock prices are pushed up. And the reverse is true: greedy, meaning buying, only when others are fearful. So when others are selling, that's the opportunity to buy. So these corrections really are the opportunity to buy. That's when you can be greedy, when others are fearful, and get some stocks at some really good values. I think of it as getting stocks on sale. So why should you listen to me over the next hour? Well, as Joe said in the introduction, I've beaten the S&P 500 for the last, since 2012, when I started investing in stocks. And because the research shows that 4 out of 5 pros underperform the S&P 500, I therefore have also outranked them in terms of profit. I started investing in 2012, went with stocks that I'd heard of, like eBay, Yahoo, Southwest Air, and then got into these triple-digit winners, I call, in 2016. These were the small cap stocks you've never heard of, like Centa, Quad Graphics, NACO, but they had huge, huge returns. Last year, I had a number of winners as well: AbbVie, Lam Research, Coors, to name a few, AMAT. And this year, I'm in some outperforming stocks as well: Boeing, Lam Research, CNC. Obviously, these returns year to date are not as strong as they've been, but when you take into effect that the S&P is down 3%, this is outperforming the S&P 500, and that's a good thing. That means we're doing better than just buying an S&P 500 index fund. And I do all this spending 10 to 15 minutes a day managing my portfolio. So why do we invest in stocks to begin with? Well, to make money, right? It's pretty simple. We make money not only to put away for our retirement, but also to celebrate and enjoy some of these wins and enjoy some of the benefits that the money can bring us. For Mark and I, we take vacations with the earnings that I've made, some of the earnings that I've made in the stock market. And we're going again in May to Florence. This top picture here, we're going to be there I'm going to be going almost for 3 weeks. Mark's coming for about 10 days, but that's all paid for 100% with the profits that I've made in Chaikin Analytics. So think about that. Think about what you can spend those profits on, and have a goal for yourself. And it makes it kind of fun when you put that, in your head and work towards it. So let me step back for a minute to just go through a little bit of history, how I got started investing in the stock market. As I said, I wasn't invested in individual stocks in 2012, but I was in mutual funds, prior to that. Ever since the 80s, when I was working in New York City for Elizabeth Arden and L'Oreal, I had senior marketing responsibility there for designer men's fragrances, which were very successful, Draco Noir and Armani. So I had a 401k plan there, and the company matched it, which was really great. They matched it 50 cents to the dollar. And that was great. And then I was able to roll that into the Franklin Mintz 401k plan when I joined them in the late 80s. And they also had a 401k plan. So between the two, I was in mutual funds such as the Fidelity Magellan Fund, which was the most successful fund of all times, Peter Lynch's fund, and Bill Miller's Value Trust, which also was really good. So my funds were doing really nicely. However, as my career was getting busier, the fund was getting bigger. I felt that I should have the guidance of a professional wealth manager oversee this, because I didn't feel I had the confidence or the know-how to make decisions. I felt that I was pretty lucky on picking those winners so far. So what he did was, and I found this gentleman on the recommendation of a friend who's in the industry. So I felt pretty confident that I was putting it in good hands. So the first thing he did was to sell the funds that I was in and put me in 10 or 12 mutual funds of his choice, which Mark later told me was pretty much industry practice. And those went along okay until, of course, the brakes came on in 2008 with the whole financial meltdown. And I remember calling him repeatedly and saying, hey, don't you think we should sell? Because it's pretty clear the market is heading in a downward spiral. Shouldn't we hold on to what we've got and just sell? And the answer always was no, it'll all come back. You're better off just staying put and hold the course. Because I lacked the confidence to override his decision, after all, I felt he's the professional. That's what I hired him for. I should listen to him. He certainly knows better than I. But after my account was down over 40% in early 2009, I had to make a change. So I took it out of his care. And Mark and I were just getting together at that time. He said, look, why don't you just put it in an S&P 500 index fund until you figure out what to do? So that's exactly what I did. But it was a real turning point in my life to go through that, because I had worked very hard for over 30 years to build that account up. And I had given up a lot to put everything I could into the savings. I always did the max I could on the 401k plan. And I gave up some things that I would have enjoyed doing, like nice vacations and stuff, to put it away into this 401k plan. And then to see 40% disappear practically overnight was pretty devastating. But what that did was it really kind of put a stake in the ground for me to say, look, I can't continue to entrust this to somebody else. I've got to figure this out so that I can make these decisions myself, or at least have a voice at the table. And I became resolved to take control. And that's what I did. I took the account back in 2009. Since then, it's up more than 4 times what it was when I took it over. So it's all good now. But the reason I'm here today explaining this to you is so that you won't make the same mistake I did and think because you don't know enough, you don't have the confidence, somebody else should do this for you. We have many wealth managers who are members of Chaikin Analytics, and they do great work. But what I'm saying is, even if you have a wealth manager, or if you're doing it yourself, or you're doing it with a partner or a spouse, you still want to be knowledgeable and educated and have a voice at the table. Because what I always say is nobody cares more about your money than you, right? I mean, think about it. It's your money. You've worked hard for it. You're the only one that knows how hard you've worked to put that money away. So taking control of it makes perfect sense. I mean, we take control of everything else in our lives. We should take control of our money too. So that's why I'm here to explain this scenario to you. So getting into the challenges, Joe and I have repeatedly asked our attendees on previous presentations what their biggest challenges are. And without question, the biggest one is always timing. When do I buy and when do I sell? And sure, there's other ones like information overload, emotions, fear, volatility, uncertainty about what the Fed's going to do. Those all enter into a challenge as well, but by far the biggest is always, when do I buy and when do I sell? So that's what we're going to be focusing on today. And this is basically, the steps we're going to follow using buy signals and that overbought, oversold indicator we have on our chart to help you time entries. And then on timing exits, give you some clear cut kind of rules, if you will, of when to take a profit and when to sense that a stock is breaking down, that you should take a small loss and get out. This is all going to be on charts from Chaikin Analytics, our workstation platform. And we'll start with a methodology you can trust. You have to have tools that you believe in and that can support your marketing, your investment decisions. For us, it's the Chaikin Power Gauge rating. As you can see here, it's a very simple rating, but there's an awful lot going on underneath the hood that meets the eye. It is a model that my husband, Mark Chaikin, created after this whole 2009 meltdown. Excuse me. When he saw my distress and he could see literally the billions of dollars that were coming out of traditional brokerage firms into self-managed accounts. I think there was like $1.3 trillion. It's a number beyond my frame of comprehension, but that's the kind of money that was coming out of traditional brokerage firms like I had and into self-managed accounts like I set up at Vanguard. And he said, Sandy, you're now managing your portfolio, but you really don't have the education or the tools to know what you're doing, which couldn't have been more true. So he said, I'm going to come out of retirement. He'd been retired for 10 years after selling his company to a division of Reuters, where he had created indicators and tools for the Wall Street pros so that they could manage their clients' money more profitably. So he said, I'm going to take the learning from my 40-some years on Wall Street and build a model that is simple enough for someone like you, Sandy, to understand, but powerful enough that it puts you on the same playing field as the pros. And was the Chaikin Power Gauge rating that he created back in 2009. It has not been changed as of today. But what this model does, the same algorithm that was in place then is in place now because it works. What this does is it looks at the potential of a stock to out or underperform the market in the next 3 to 6 months. And it is the foundation of the conversation we're having the rest of this hour because it is the centerpiece of our platform. So you can see here it's basically broken down into 4 components. It takes all the data on the right, it crunches the data and analyzes it. That's a key. It analyzes it so you don't have to. And it comes out with an overall rating. You also can drill down on a rating, bullish to bearish, on any of these 4 components. And what it does is it really cuts through the clutter. Information overload is usually one of the key challenges that attendees mention. There's so much information out there. How do you know what to believe? And how do you know what to listen to? And how do you know what you should tune out? Well, the Power Gauge really helps you do that. And I know there's a lot of people from the John Carter community today, including a number of people who heard Mark and John speak 2 weeks ago out in Austin at their strategic investment conference. But John and Henry, who works there as well, are devotees of the Chaikin Power Gauge rating. They use it every day in their analysis of stocks. And what John said here is that there's a lot of hyped up tools out there, but a single tool that combines 20 technical and fundamental factors to anticipate a stock's profit potential got my attention. He calls it an objective awesome meter for stocks. And most models include either fundamental data or technical data, and not the combination, but this combines both. For those of you who are interested, it's 85% fundamental, 15% technical. And it is a huge aid in analyzing the potential of a stock as well as the timing, when you're going to buy and when you're going to sell. So what are those 20 factors? Well, here they are right now. As you can see, they're broken down into the 4 major components. Financials being the components, the factors that a value investor like Warren Buffett would look at. Earnings is something that a Jim Cramer would be very interested in. Expert opinions is really our secret sauce. It's not likely you're going to find this information easily at other places, particularly the short interest or the insider activity. But I highlight those in red because those are two of the 3 or 4, the other ones are in red as well, factors that I drill down on when I'm evaluating a stock, other than looking at just the overall power gauge rating. When I'm buying a stock, I want not only the rating to be bullish or very bullish, but I want these factors to be bullish as well. And during earnings season, if I'm going to buy a stock right before they report earnings, it's critical that this earnings component be strong, and in particular this earnings surprise, because the earnings surprises tend to affect the estimate trends, which affects the volatility that surrounds that stock once they report. Did they meet analyst estimates, or did they exceed them? If they exceed them, that stock is likely to spike up after earnings. If they disappoint, it can really drop fast like a stone. So watching that earnings surprise and earnings component in earnings season is really incredibly helpful and powerful as well. Okay, so models. Why do we like models instead of human minds? Well, this well-known analyst says models be human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by, guess what, emotions and opinions, right? I mean, this is what we're trying to get away from, having an objective view of the market. That's what the power gauge does. It takes out all that emotion and guesswork, and it's just the facts are the facts. Just so you have some confidence that it's just not me telling you that the power gauge works and is accurate, but we partnered with NASDAQ 4 years ago to create indices for them based on the power gauge rating, where we took their large cap, small cap, and dividend achievers indexes and overlaid the power gauge rating on those and filtered out any stock that wasn't bullish. And that then became the NASDAQ Chaikin index. For all three, they've significantly outperformed their benchmarks since they were created in 2014, which got the attention of New York Life's Mainstay Investment Division. And they've licensed these so that now money managers and their clients, individuals like you and me, can now invest in a portfolio of stocks. These are ETFs based on the Chaikin power gauge rating. So it's powerful. It's powerful. It's proven. You can believe NASDAQ and New York Life put it through its rigors, testing it every which way to Sunday. In addition, the power gauge is used by pros quoted in the media. Mark was quoted yesterday in CNBC, and he's usually quoted several times a week on CNBC and the other major financial networks and publications, as you can see here. And I know there's a lot of you here from Jim Cramer's community from when Mark and Jim did we call it like a fireside chat, January 31st, which was an awesome presentation. It's up on our website. You're welcome to go there, chaikinanalytics.com. If you weren't on the January 31st live event, it is recorded, and I highly recommend you listen. It's two pros really evaluating the market and where it's headed. But what Jim Cramer says is the Chaikin model is the best. He's used it at his old hedge fund. Okay, what to buy? Before you can know when to buy something, you've got to know what to buy, right? So let me take a minute here to explain what you want to look at when you're evaluating a stock to buy. Because if you get your timing right and it's the wrong stock, it doesn't matter, right? It's still not going to be a good decision. So you got to know what to buy. We call it a classic bull. And these are the attributes that a classic bull stock has to have. Let's go through them in a little detail on an actual chart. So this is a classic bull, Progressive Insurance. This is a great stock idea for those of you who are looking for stock ideas. We look at the chart from the bottom up, which is a little different from what most services do, but the bottom ribbon, this green solid ribbon with a few ticks to yellow, is the power gauge rating. This is the most important thing on this chart. Power gauge rating, remember, rolls up 20 factors. So you've got 20 factors weighted into this green ribbon here, telling you that the outlook for Progressive is strong. It is likely to outperform the market over the next 3 to 6 months. And when you ask yourself, well, gee, how do I know this works? Well, all you have to do is look at a chart, and did it go up 3 to 6 months out? Yes, it did. So there's your proof right there. That's really all you need to know. You also want the stock to be strong relative to the S&P 500. Because if it's not going to be outperforming the S&P 500, you might as well take less risk and go with an S&P 500 index fund, which over time has averaged 10% a year, which is not bad. So, but if you want to get those outsized returns up into the double and even triple digits, then you've got to look at stocks that have the makeup that I'm going to be walking you through right here. Starting with the strong power gauge rating, relative strength is strong relative to the SPY. It's outperforming the SPY. And you want money flow to be strong. And money flow is measured by these green and red, I call them mountains. And this is an indicator Mark created some 30 years ago when he was on Wall Street to measure institutional money coming in and out of a stock. The reason that's important is because the institutions buy in such bulk, as you have seen in the last month, that when they buy or sell and they put through orders, it triggers a whole domino effect that affects other instruments like ETFs and mutual funds that carry that stock. So when they're selling something, it has huge reverberations throughout the market and the pricing. So you want to be aware of that. And this is a brilliant indicator that does just that. I love this money flow, because if it's green, it means the institutions are buying. If it's red, as you can see here back in September, it means the institutions are selling. And you can see how significant that is in correlation to the price. When this is red, price is flat or dipping down, right? And you can see that here recently in February when money flow went a little bit red, it also dipped down in price. Look what happened when money flow turned, and everything else being equal, stocks started going up. That's how powerful money flow is. So be on the right side. You know, you want to be on the side of the winners, of the money. Follow the money. And of course, you want a stock that has a rising trend. And this orange line is a 200-day moving average. So it's pretty easy to chart. This is now trading above its 200-day average in a market, you know, that's had a really tough road the last month, down 3% for the year. You know, Progressive is looking pretty good, right? So this is a great stock idea for you if you're looking for stock ideas. I'm going to explain the overbought, oversold a little bit later. But let's look at one of these small cap stocks, because the small caps now are really strong today. They're outperforming the large caps. They have less exposure to the overseas markets. So when Trump is rattling the sword with China and other countries over tariff wars, the small caps have less exposure to that because they tend to have just their economy in the U.S. Heidrick & Struggles, this is a search firm, a small cap stock. Let's look at the chart on this. Strong power gauge rating since October, outperforming the market since November. And look at the money that started really coming in November. And you can see how significant the pattern is once everything lines up green. The stock goes from basically, what is that, about 23, 24, you know, up to as high as 32, and a little bit of a pullback today to 30, the last couple of days to 30. So that's the the setup you want to look for. This is the perfect setup. This is a great stock idea. And look at the money coming in. And look at what happened when that big chunk, the money really started pouring in. It just shot up. These are volatility bands, these dotted lines. Typically, a stock stays within that price range. So when it's above this volatility line, it means it's not really likely to stay up there. It's almost too high for it. It tends to pull back. The middle one is kind of the average. And if it goes below the volatility band, it's likely to be on a downward trend. So you want to, again, follow the trend line. You want to go with a stock that's growing, not consolidating, right? That makes sense, right? All right, so how do I find these stocks? How do you find a progressive, and how do you find a Heidrick & Struggles? I mean, we've got 5,000 stocks in our system. How do you sort through 5,000? How did I find these two? Well, I'm going to show you a second in the screener, which I'm going to go to. But before I do that, let me just read you this quick testimony. We get a lot of testimonials. This is from Sandra in late January, saying her 401k plan was up 47% last year. How many of you can say your portfolio was up 47 or higher percent last year? If you do, just put it into the Q&A, and good for you. All right, I don't see too many answers. I don't see any answers, actually. So, I mean, good for her, right? She says she couldn't have accomplished this without the help of the entire Chaikin team. Sandy's encouraging words, "You can do this, and here is how," was so empowering. And that's what today is all about. You can do this, and I'm showing you how. My husband has confidence in my judgment. Thank you, Chaikin, and I feel empowered. Life is good. When you feel empowered, it is the greatest feeling in the world. And I can speak from experience, because now that I feel empowered to manage my own money, which I do, I don't discuss it with Mark. You may find that hard to believe, but it's better that I just do it myself and have my own thoughts on it. I certainly read his market commentary every week and listen to his webinars and read what he writes for CNBC, etc. But I make my own decisions on what I'm going to buy and why. And that's a powerful feeling. And I couldn't do that without confidence. So today is all about giving you the confidence to make these types of decisions for yourself and feel empowered. Let me tell you, it permeates throughout every aspect of my life. It's not just about investing my own money now, but it's about really taking a stand and being powerful in other aspects of my life as well. It's a great confidence booster. All right, so I said I was going to show you how I find these stocks, and here's how I found Heidrick & Struggles. We have something in the workstation called Screener. This is huge time saver. And what this allows you to do is type in your criteria, and then it'll screen the universe of 5,000 stocks and give you only the stocks that meet that criteria. And you can save the criteria. So what I do is save this criteria. I only want to look at a stock universe of strongest stocks. The research shows that if you invest in strong stocks in strong industry groups, they're likely to outperform the market. So you might as well go with the strongest industry groups. And the screener, by selecting that, will only give you the top 20%. There's, I think it's 100, I think it's 85 industry groups. There's anywhere from, like aerospace to utilities. They're coal. They're all over the place, and every stock gets assigned an industry group by the leader of this, Zacks. And so everyone kind of depends on Zacks to pick the industry groups that each stock should go into. But once they've done that, we then rank them by power gauge rating. So we take we identify the strongest industry groups as proportion of strong power gauge rating stocks in relation to bearish power gauge rating stocks in that industry group. And then I plug in the other criteria based on that classic bull pattern. Bullish power gauge rating, these three factors I like. If it's earnings season, I'll replace one with the earnings surprise. I was looking for ones that are oversold, ones that we could buy now, and I'll explain that oversold in a minute. Strong money flow and strong relative strength. So I took a universe of 5,000 stocks. In literally 20 seconds, I had 4 candidates that met that. Heidrick and Struggles was one. And then I can put these into a list. I can add them to a watch list that I'm keeping track of every day. And that's how I find my winners. That's how I find stock candidates to buy. So Cheryl also gave us a testimonial. There's not enough time to do the work Chaikin puts before me in minutes. I am wowed. This is an enormous time saver. And how many of you are short on time? How many of you would like to save time researching stocks? If you do, just put that into your Q&A box that you'd like to save time. And I bet I'll get a lot of those. Bob, I'll answer your question. When short interest is strong, does that mean that there's a lot of people shorting or just a few? It means there's a lot of people shorting, and the short sellers are considered the smartest people on Wall Street. So if you got the smart traders shorting the stock, meaning they're selling it before they buy it because they're anticipating that the stock is going to go down, you don't want them shorting the stock you're interested in buying for the longer term. And Craig, as a private money manager, my stock portfolios perform better than anything else. Awesome. Good for you. I wish I knew you in 2008. That's great. Okay, so I didn't see anyone saying they had too much time on their hands. Okay, so it's just as important to know what to avoid, and let's quickly go through this. This is obviously the flip side of a classic bull. And let's go back again to Warren Buffett. Avoid risk whenever you can. And a lot of investing is all about avoiding risk, minimizing risk. I mean, what I had to learn in 2009 when I started investing myself is that I am going to lose money. It's unavoidable. Not every trade is going to be profitable. And that took me a while to get my arms around that. So the trick is to successful investing is to minimize it. Avoid it whenever you can. And that's what the classic bear pattern can help you with. Here again, it's just the opposite of a classic bull. Power gauge rating is red, meaning the stock is likely to underperform the market in the next 3 to 6 months. Relative strength is underperforming the S&P 500, and there's money kind of coming in and out. And these red triangles are sell signals. We have 6 pairs of buy and sell signals that trigger when certain criteria is met. These are overbought, oversold, and now I'll explain the overbought, oversold, which is this indicator right here. Stocks prices don't go straight up or straight down, right? They zigzag across, they pop up, they pull back, and they have this zigzaggy pattern. This helps chart that and makes it very visible to know that when it's up like this in this 70 range, this is when, if you're selling a stock, this is when you want to be selling it, when it's up here. You want to be buying it on these lower dips below 30, as you can see here in February, which correlates with this dip here. So this really helps with timing, and timing is the topic of the webinar. So I'll be pointing this out on additional charts as well. So let's get into the timing secrets. I wanted to spend the most amount of time on this, so we're there, which is great. When? Well, the signals, the buy signals, really help identify when to buy and when to sell. If they trigger, that's a clear-cut call to action. And that overbought, oversold indicator that I was just explaining. So here's the criteria for when to buy. Let's break it down. And if you're following this in the workbook, this is on page, I think it's 13. It starts on 13, goes to page 15 of the workbook, where we go into these pattern methodologies of when to buy and when to sell. Okay. Certainly a good time to consider buying is when you see a buy signal. It doesn't mean like, oh my God, if you don't buy it right now, you're screwed. It just means this is a good time. Take a look, and if other things all fall into place, consider buying the stock right now. Oversold, again, this up-down, this measures the zigzag pattern of the stock. You want to buy it when it's dipping down. You want to sell it when it's up here. And you want, if you're buying the stock, you want that classic bull pattern. You want the strong power gauge rating. You want relative strength and money flow to be outperforming the market. And this is the Wyckoff chart, which really charts the typical course a stock price moves. This was created by Dr. Wyckoff, I think it was 95 years ago, and used when he was teaching how to invest in the stock market. This is still applicable and relevant today. But if you understand, this is taking what I call the zigzag pattern. And if you understand that this is basically how a stock price moves, then you'll wait for the pullback or correction to buy it. And you'll wait for this pop up here to sell it up here or buy it down here. And understanding that this pattern is reliable can really help you time your entries and exits. So I've been mentioning the alerts, the buy-sell signals. How do I know when those trigger? Well, we've made this easy by giving you what we call an alerts view. It's an overlay that you can put on any stock list, and I did it here on my watch list. I keep two lists, my stock list, stocks I own, and I tend to own 12 or 15 at any given time, and stocks that I'm watching. So these are candidates to buy. These are like the HSII, Heidrick and Struggles, that I saw on a screener yesterday that had been on a screener for a couple of weeks, and I thought, okay, great. I'm going to follow this stock and buy it when the time is right. That's what I call the watch list. So yesterday I overlaid, with a click, the alerts view onto my watch list, and this is what it gave me. It tells me which stocks on that list triggered a buy signal. You can see Heidrick and Struggles here triggered that oversold buy. It also tells me other important things that can affect the price of the stock, like a power gauge change. It's telling me CMA went from neutral to bullish. Well, that's informative. Huntington Ingalls went from neutral to bullish, okay? And PVH is telling me that there was an estimate revision to the upside. If it was an estimate revision to the downside, it would be over here under the bearish alerts. And as you can see, there's no sell signals or other alerts under the bearish section, but they'd be showing up here if they were. This is how I found that there was an oversold buy signal on Heidrick and Struggles. And let's look at that chart again. We looked at it earlier under a classic bull because this is a classic bull pattern. Here's the buy signal, the trigger, right here. What I do is I overlay that signal to see, well, gee, tell me where else, show me where else that signal triggered to see if it was reliable. And they are reliable about 70% of the time. And I'm looking at this. Okay, this was good. This was good. If I had been watching this stock and gotten one of these signals there, that would have steered me in the right direction, right? So that's given me confidence that the signal that just triggered yesterday is reliable as well. Look at the money. I mean, I love, as you know, I love Chaikin money flow. So if there's a lot of money coming in like that, look what that's done to the price. And now we've gotten this little pullback here. So this, to me, is a really good stock to buy. And that's high on my list as candidates to buy. It's also oversold, obviously, from the oversold signal, but it's it's triggered because it's dipping down here. And remember that Dr. Wyckoff chart of the zigzagging. You want to buy it when it's down here. Everything else is strong, right? Power gauge, relative strength, big money. So everything's lining up to say this is a good stock to buy. So even in the throes of this market, there is opportunity if you know how to look for it. And this is how you can find it. Another example of a buy signal is a money flow buy. Okay, this is a stock I bought back here when this money flow buy triggered in November. This stock had been on my watch list. Again, just like I do every morning, I overlaid the alerts view, and in seconds I could see what stocks had triggered a buy or a sell or a estimate revision. And I bought this back in November at 54. I also bought it because everything else lined up. Just because there's a money flow buy doesn't mean it's oversold. So you may need to wait a little bit, but in this case, it was oversold and everything else was green, so I bought the stock. And as you can see, it's had a pretty nice run, even in the midst of this, S&P being down 3% on the year. This stock is holding up on its own. So that's about that. That goes through the when to buy, when to sell. There's two scenarios. Either you're going to sell to take a profit, or you're going to sense that there's a breakdown. And I'm going to break this down into two components. And let's go through taking a profit first. There's three basic scenarios where you want to take a profit. If the price hits that upper volatility band, remember that's that dotted line, and I said a stock is not likely to go outside of that. So if it does bump up past it, it tends to be fleeting, and grab it, take the opportunity and sell and say thank you. Price is overbought. That's that zigzaggy pattern, obviously, that we just talked about. Or the price spikes up after a strong earnings report. And this we haven't talked about, but that's why that earnings component can be so valuable when you break it down on the power gauge rating. If you can anticipate a stock that has a really strong earnings component and is going into earnings, there can be a strong potential for that stock to exceed the analyst expectation and spike up. It took me a while to really understand earnings. A lot of people are afraid of trading in earnings, and I actually look forward to it because I see it as an opportunity to make some really nice profits. Reason being, the price, what took me a while to learn is that the price will spike up if the company exceeds the analyst estimates. And it's all about what the analyst estimates are. It's not about last year, beating last quarter. It's all about, can a company exceed analyst estimates? And if they exceed, you see a pattern like you see here of them reporting here and spiking up. And you can learn to take advantage of this. So this is one of these small cap stocks that I profited from very nicely in 2016, I think, and again in 2017. And here's what I did. So I had this on my watch list. I got a relative strength breakout buy right in here in September of this last year, and bought the stock at 35. Everything else was lining up. I watched it go up, and I looked at what they did when they reported earnings. And you can see our earnings component here is telling us now this stock is now going to be reporting May 2nd. But at the time I bought it, it told me that it was going to be reporting in here, I think it was 12/4, 11/29, 12, something like that, end of November. So I looked at the past earnings, and look what happened. If it's beige, if it's just kind of gray like this, they met estimates. And look at the spike. It's huge. The stock went from like, what, 28 to 38 the next day? And then look, it pulls back, which is what typically happens. Did they do that before? Yeah. I mean, this is consistent. Look, going back here to May, August, and again in November. It did it again, but look at the pattern. It spikes up and then it pulls back. And looking at how it did that before, it pulled back and then it spiked up, pulled back and then spiked up. So when I saw the stock pull back right after they reported earnings about 10%, I didn't panic because that's normal. That's what this stock does. And everything was green. So I'm like, it's going to spike up. And a few days later, I got my wish. It spiked up and I sold it, for 14% profit at 40. Again, going above this upper volatility band. As you can see, that's a really great tell for, like, take your profit now and say thanks and get out of this stock, because they tend to pull back. Again, it went up in February, tend to pull back, right? And look what happened when they reported earnings in February. Again, dropped, and then spiked way up. And if I had been in the stock, I wasn't, I was out of it up here. But if I had been in the stock or had rebought it, this would have been a good place to sell it as well. So that's how you can make profits after earnings, as well as hitting up against that volatility band. I'm a sailor, so I think of this as outside the channel. These dotted lines keep me in the channel. If it goes outside of it, you're apt to run aground. So stay in the channel. Let's look at LPL Financial. This again had been on the screener. This is where I get my ideas. I get them from the screener. I put them on a watch list. This had been on the watch list. I bought it in January here when it had pulled back a little bit before earnings. I knew they were reporting earnings because I knew from the little calendar up here that told me, and I flipped through my bullish watch list stocks every morning, so I know when they're reporting. I knew it was coming up. I said, okay, I'm going to buy this on this like dip. Pulled back about 6%. I'm going to just buy this on this dip in anticipation of them coming out with a strong earnings report, because the earnings component was very strong. It's strong today. It was strong then. And you can see here, I've highlighted it here on the breakdown of the power gauge rating. So that gave me confidence going into this earnings report that they were going to exceed, and they did. And they bumped up 9% the next day, right after they reported. And I said, thanks very much. It's at the upper volatility band. I'm going to take my profit after 2 weeks and put the money in the bank. The money was also starting to get a little negative. Some negativity is normal, particularly now with so much buying and selling going along by these programmed trades. But that just added to the argument that sell it, when it spikes up on that, above that upper volatility band. And in this case, from earnings as well. So let's look at another one, Columbia. Again, this was on my watch list. I found it, I think I found this one on the screener. It goes back to September. I can't really remember. Sometimes I get ideas from Mark or from our chief market analyst's daily market letter. Mark writes one every Sunday, recapping the week for our members. And Dan Russo, our chief market strategist, writes a report every day, Monday through Friday. And both include stock ideas. In particular, they single out a stock to feature. You can get great ideas that way. And I may have gotten Columbia from Mark's market commentary one week. But in any event, it was on my watch list. I overlaid the alerts view one morning, see that there's a momentum breakout signal. Everything else was lining up, including being oversold, strong money, strong power gauge, strong relative strength. So I said, great. And going into earnings, earnings was a few weeks away. So again, I dropped down the earnings component on the power gauge rating. It was very strong. So I said, great, I'm going to buy this now. and anticipate that they're going to spike on earnings, which is what they did. I don't know why I didn't sell it up here. Normally I would have and bought it back down in here. But in any event, I carried it all the way up to the next earnings report when it spiked up yet again and sold it up here at 77. So I bought the stock at 61, sold it up here when it bumped up into that upper band. Again, that upper volatility band is your signal to say thanks very much. I'll take my profit. And it also was, due to the earnings. They beat the analyst estimates, so that's why it spiked up. So let's go back to with Warren Buffett. Be greedy when others are fearful, and be fearful when others are greedy. I was not fearful, but I sold when others are greedy. Other investors see, oh boy, they exceeded their analyst expectations. This is a great stock. I'm going to buy this. And a lot of people pile into it, and that bumps the price up. And that's when I can say, yeah, I'll sell mine to you. Thanks very much for driving the price up. That's the Warren Buffett model. Be greedy when others are fearful, and fearful when others are greedy. Keep that in mind. So that was a nice 25% profit in 4.5 months. Now the other scenario of when to sell is if you're sensing there's a breakdown. And I have two examples to show you here on how you know when a stock is breaking down. There's a couple of tells. Power gauge turning negative, and another indicator like money flow or relative strength turning negative. Certainly if you get a sell signal, one of those red triangles popping up on a stock you own, take a very close look. Or if the price drops below that orange line, that 200-day moving average, or price drops below the lower volatility band. And again, this follows this Wyckoff pattern of zigzagging across, and then it zigzags down, up a bit, down, across, down, up. So it's obviously the direct opposite of the pattern on a bullish stock when it's rising. But being aware of this pattern really does help you time those entries and exits. So this is still the best example I have. It goes back to 2016-17. I bought this stock back here in November of 2016 on a momentum buy that I didn't overlay the momentum buy, but there was a momentum buy signal right in here, which is what gave me the alert to buy it. Insurance, Maiden Holdings, was a very strong category at the time. Power gauge was bullish, and the strong relative strength, strong money flow, and as you can see here, is oversold. So this was a good pullback, along with a buy signal to buy it. So I'm in the stock, and I'm watching it go up, and then for no reason, it just bumps up to this upper volatility band, and I thought, oh, this might be a good time for me to sell this stock, particularly since the money down here was just turning negative. It just had turned. Everything else was green, but it was also overbought. So it was zigzagging up, not down, meaning, this is a good time to sell. So everything pointed to taking the profit, which is what I did. I took the 17% profit in, November to February, so a couple of months, and was very happy. A couple of days later, literally 2 days later, they pre-reported a very negative earnings report, and the stock dropped 10%. It was really bizarre. And then a few days later, they reported as scheduled, and the stock dropped another 10%. At this point, power gauge had turned neutral, relative strength had turned negative, and you started to get a persistent patch of money coming out of the stock. The stock was breaking down. This is the pattern to look for. Fortunately, I was out, but if I hadn't been out at that upper volatility band, seeing this would have given me pause. And it was dropping, and you see here it dropped below that 200-day moving average, and it dropped below the trend line. So all of these things just pointed in a direction of, hey, this is, if you're not already out of this stock, you should sell it here. And that was when it was, I guess it was around 16. I mean, the stock is now 6. So how would you like to hold the stock, having bought it at 16, watched it go up to 19, and then watch it to go down to 6? I mean, that's heartbreaking, right? That's devastation. So you don't have to do that. With following these guidelines, this is the pattern you would recognize and be out of those stocks early. A more recent example is Reinsurance Group. This is, again, another insurance company that I bought recently. I bought this back in December on this buy signal here, oversold buy. Everything else at the time was green, including money flow. So I bought it at 155. And then you can see what happened. Money flow turned negative here. I don't know why I didn't sell it up here. I should have sold it here because money flow was negative. I probably thought because of the previous earnings calendars and trend that they were going to report a better than expected earnings. That's probably why I didn't sell it up here with earnings being like the next week. But they disappointed and the stock dropped. And I sold it that day, the day they reported. I sold it at 155, having bought it at 160. So I took a small loss, a 3% loss. But, that's a lot better than the loss if I had held on saying, oh, I think I'll wait for this to come back, because they did get kind of burnt from those pullbacks recently in February, and it's now down at 150. So this is the type of pattern to look for and get you out of these stocks before they go through that bottoming out. Norm is a subscriber of ours. He's saying, through following your excellent system, my portfolio now stands in excess of $1 million. Before Chaikin, I would make money and then lose it. Consistent earnings, and I underline consistent earnings, were just not a reality. Chaikin has changed all that. I can't thank you enough for your tremendous service and excellent methodology. So we have a whole support staff who was working with Norm and answering his questions and giving him training, small group training as well as one-on-one training. So if you invest the time to learn Chaikin Analytics, there's no reason why you can't achieve the same success as Norm. So let's recap the steps we just reviewed today on how to time your entries and exits. Looking for those buy and sell signals and the overbought, oversold indicators, knowing when to take your profit, and knowing the signs that a stock is going to be breaking down. And again, I refer you back to the workbook. They're all on page, I think it's 13 to 15. And keep that handy, when you do your review every day of your stocks. But this all has enabled Mark and I to take some really great vacations, which is pretty cool. So think about where you want to spend some of your profits and make that a goal. And it's kind of fun when you take some profits, you go, okay, great, that's going to go towards my trip to Turkey or Italy or wherever you're going, the Caribbean. This is all done on the Chaikin Analytics platform. We won an award in May of last year for the best stock idea platform from Benzinga, which we're really proud of. We didn't even get into some of the reasons why, which is a screener. It's like a Pandora for stocks. You seed it with a stock, and it tells you other stocks like that. The screener that I showed you certainly helped put the judges in our favor for that, winning that award as well. Another subscriber of ours, Ken, has gone from 235,000 to 1,200,000 in 7 months. He said he found it last January, a year ago, and as of July, he was up to $1 million profit. He said he would not have been able to achieve this without your system. So again, the system is comprised of primarily, the power gauge rating as the core, the 20-factor model. The stock discovery engine, that's like the Pandora for stocks, which we didn't have time to review today. But when you subscribe, you will have a session as early as tomorrow to go over how to use all the features, how to put your stock list into the workstation, how to trigger those alerts, overlays, so you know when buy and sell signals are triggered, and how to use the stock discovery engine. It's all very simple, but it's helpful to have it all pointed out. The screener is included. We have an options overlay for those of you who trade options. It gives you the best risk reward on a option strategy and 3 strategies to choose from, which it rates. So it really does all that calculation for you. And the platform is usually $2,195 a year. But as a webinar special, we're taking $300 off when you subscribe by midnight Friday. But if you'll wait for 1 minute, I'm going to give you an even better offer than that. I'm going to sweeten the pot. So Alex here very recently, March 7th, a few weeks ago, said, "I can't tell you how happy and grateful I am to have found Chaikin. I found you through Jim Cramer, and this is a day that changed my investment life." This is from that January 31st, I call it a fireside chat that Jim Cramer and Mark broadcast live from thestreet.com in New York, January 31st. But that changed his life. It can change your life too. So more free bonuses that are included. I didn't get into it, but we have intraday pricing, really helpful for buying and selling. The earnings feature, I didn't do the drop down other than just point it out, but it gives you the data that you need to know to anticipate whether it's going to beat or miss. And this is a view of the marketing insights commentary that Mark puts out every Sunday that's available on desktop, or you can read it on the iPad or iPhone. And then this is a really big, I just think this is a huge benefit. I'm really excited about this. But we get you into small group tutorials right away, as I said, as early as tomorrow. And that will really help you set up and use all the features that we're talking about here. But you have unlimited coaching and support. You can attend as many coaching and support sessions as you want. And if you want to work it into your own investment methodology, and how do you incorporate Chaikin into what you typically do, you schedule a one-on-one. Or if you have a certain orientation or topic you want to get more deep dive learning on, you can schedule a one-on-one with one of our customer success team members. And I really don't know of any other service that will do that. This is all free. This all comes with your subscription. So I told you I was going to sweeten the pot. We'll take an extra $100 off your annual subscription when you subscribe by midnight tonight, when you become a member of the Chaikin community by midnight tonight. So Joe, I know you've been answering questions as we've been going along, which is great. I'm going to turn this back to you and thank the audience again for taking time out of your busy days to listen to the presentation. And I hope you have found it extremely valuable in identifying when to buy and when to sell a stock.
All right. Thank you all. Thank you, Sandy, for your presentation. And thank you, everybody, for joining us. Again, that's $17.95 for a full year to Chaikin Analytics. You can go right to chaikinanalytics.com/Sandy. Or, of course, give us a call at 877-697-6783. We have an onboard session taking place tomorrow at 2 o'clock Eastern Time. This is a great way to hit the ground running and understand all of the analytics that we provide. There were a lot of questions about the different types of data available, how often the power gauge rating is updated, things along those lines. We're going to cover all those types of questions on the onboard session tomorrow. In the meantime, though, be sure to take advantage of Sandy's offer, a full year's worth of access, $17.95 to Chaikin Analytics. Again, that's 697-6783, or you can go right to our website, chaikinanalytics.com/Sandy. So big thanks to Sandy again for the presentation. Thank you all very much for sticking around. Keep an eye out for the recording to be sent out tomorrow to you. In the meantime, have a great evening, and we'll see you on tomorrow's onboard session.